The global fracture, shadows of protectionism, debt traps, and the AI race 2026. Welcome to Economics Without Myths, your weekly deep dive into the forces shaping global finance. Today, we navigate a labyrinth of conflicting signals. On one hand, certain sectors are booming, driven by an insatiable appetite for artificial intelligence AI infrastructure. On the other, we see mounting geopolitical risks, protectionist trade policies, and a persistent inflation that continues to frustrate central bankers. The narrative of a soft landing is being challenged by a growing sense of fragmentation. The global economy, rather than converging, is bifurcating along geopolitical fault lines. Chapter 1: The Tariff Wars and the End of Globalist Efficiency. The most significant development in recent news is the escalation of tariff wars between major powers. Specifically, the U.S. decision to hike tariffs on strategic Chinese goods, electric vehicles EVs, semiconductors, batteries, and solar panels. This isn't just a trade dispute, it's about national security and the fundamental restructuring of global supply chains. The rationale from Washington is twofold: to counteract unfair state subsidies that lead to dumping and to protect nascent domestic industries. A 100% tariff on Chinese EVs effectively seals off the U.S. market, preventing competitors like BYD from challenging American automakers. However, this triggers predictable risks. Beijing has signaled necessary countermeasures, which could hit U.S. agricultural exports or restrict critical minerals essential for high-tech manufacturing. Companies are now forced to choose sides, adopting friend-shoring strategies, relocating production to politically aligned nations like Mexico, Vietnam, or India. While this builds resilience, it introduces inefficiencies and raises costs for consumers. Europe finds itself in a precarious middle ground. While Brussels investigates Chinese EV subsidies, it hesitates. European automakers fear a flood of diverted Chinese goods, but nations like Germany rely heavily on exports to China. A tit-for-tat war could devastate European luxury auto and machinery sectors and slow down the green transition, as the EU remains a major consumer of Chinese solar technology. Chapter 2: Macroeconomic battles and monetary divergence. As trade wars heat up, central banks continue their struggle against stubborn inflation. While headline numbers CPI and PCE show moderation, core inflation in the service sector remains elevated. The market expectation for Federal Reserve rate cuts has shifted drastically from 6 cuts projected at the start of the year to potentially just 1 or 2. This higher-for-longer stance prioritizes the 2% inflation target but tests the limits of the labor market. This high-rate environment strengthens the dollar, creating a crisis for emerging markets. Capital is being pulled away from riskier developing economies, and servicing dollar-denominated debt is becoming prohibitively expensive. Recent currency devaluations in Egypt and Nigeria are early warning signs. Simultaneously, the European Central Bank ECB may cut rates sooner than the Fed due to weaker Eurozone growth. This divergence could further weaken the euro, adding inflationary pressure to European imports. Chapter 3: The AI Boom, Growth Engine, or Market Bubble. In the technology sector, the narrative is dominated by the AI arms race. This isn't theoretical. It's tangible in the massive capital expenditures from giants like Microsoft, Google, and Meta. Nvidia remains the primary victor, with its near monopoly on GPUs defining market movements. However, supply chain bottlenecks are emerging. The demand for advanced high-bandwidth memory, HBM, and CoWoS packaging far outstrips the capacity of TSMC and Samsung. The concentration of semiconductor manufacturing in Taiwan reintroduces high geopolitical risk. Any tension in the Taiwan Strait creates immediate volatility, reminding us that the digital economy rests on a single fault line. Furthermore, questions about the AI war are surfacing. Will the massive hype translate into sustainable productivity gains in traditional industries, or are we witnessing a dot-com style bubble? Regulatory scrutiny in the US and EU regarding data privacy only adds to the uncertainty. Chapter 4: Energy Volatility and the Green Paradox. The energy sector remains a hostage to conflicts in the Middle East and Eastern Europe. OPEC+, led by Saudi Arabia and Russia, has shown resolve in keeping production quotas tight to maintain high oil prices. For consumers, this means persistent costs in transportation and logistics. In the natural gas market, Europe has diversified through US LNG, but the system remains fragile. Any cold snap or supply disruption triggers price spikes due to intense competition with Asian markets. A new paradox has emerged. The AI boom requires vast amounts of electricity for data centers, straining power grids and forcing a continued reliance on traditional energy sources even as nations strive for carbon neutrality. Chapter 5: Labor Resilience versus Consumer Exhaustion. The U.S. labor market continues to defy expectations, supporting the soft landing hope. However, a tight labor market fuels wage growth, which in turn keeps service sector inflation high, a feedback loop the Fed is desperate to break. Conversely, a cautious narrative is emerging for households. Savings from the pandemic era are being depleted and credit card debt has reached record highs. While people are still spending on experiences like travel, rising delinquencies and auto loans suggest that the consumer spending spree may be nearing its end. Chapter VI: The New Investment Paradigm. The convergence of protectionism, inflation, and technology is creating a new environment for global business. We are moving from a just-in-time globalized model to a fragmented, de-risked model. Investment is shifting away from low-cost labor towards sectors deemed critical for national resilience, defense, domestic energy, and semiconductor independence. Nations strategically located or rich in resources are faring better, while those with high external debt struggle. The next quarter will be defined by core PCE inflation data, geopolitical events in flashpoint regions, and the ability of tech giants to turn AI investments into actual revenue. Summary: the myth of a single, interconnected global market operating under predictable rules is being dispelled. We are entering an era where economic policy is a tool of national security and industrial competition. For businesses, this requires a re-evaluation of long-term strategies focused on diversification. For investors, it means navigating a world where traditional correlations are breaking down. We will be back next week to analyze the next set of developments shaping our financial landscape. Thank you for joining us on Economics Without Myths.